Hey everyone, welcome back to Lunch at the Market. Today we're talking about our trade repair. Most of the market is green today, and that's fantastic. And then there's a big red name that's on your screen, at least that's on our screen, and that's Cree. But thankfully, we had some super bearish bets going into earnings, which were yesterday after the close. Bearish bets, down stock, equals happy face, smiley face, and green on your screen, even though the stock itself is red. So you may remember that we had a long 45, 40, 35 put butterfly on Cree. Now, all that is a long put spread paid for by a short put spread in which they share the middle strike. All we did today is roll that top strike down to the bottom strike. Nothing changed about the middle. We're still short the same number of contracts. All we did is take this number of contracts, roll them down to the lower side, and turn it into a short put spread. Now, why did we do that on Cree? Especially because the name has been terrible. Well, we got paid $5.60 to do it. Yes, that's right. We got paid the entire width of this spread to roll this strike down from here to here. Well, this long put spread is only worth $5, right? From uh, 45 all the way down to 40 is only worth $5. So by rolling that down, our max risk on this trade is now $5, and we got paid $5.60. Okay, so we have 60 cents full. That's profit. We're gonna take it home. Remember, none of the amounts changed, right? This amount didn't change. This amount didn't change. This amount didn't change. All we did was roll this down. So this risk stays the same. We took in an additional 60 cents to do the trade. So we basically realized the entire full profit of our long put spread. Now we have a 60-cent credit that we get to keep no matter what happens to the stock. So every dollar above $35 that we get an additional dollar of profit. Okay, so we're going to take in that additional profit for rolling down, and then we're just going to bide our time until May options expiration. And then the put spread will expire. If it's in the money, then we'll buy it back at some cost. Say we'll pay $2 or $3, and so we'll get to keep the difference between what we took in today to roll down and what we have to pay out to buy it back. So we don't have a concern anymore in terms of where Cree goes from here on the May butterflies, because we've already realized our full $5 profit. We actually took in $5.60 to roll that trade down. So it's a really good situation that we're in. We're also hedged. We have the June 35-30 long put spreads out the next month as an additional hedge on the stock. And so we kind of win both ways. Either our put spreads, our 40, 35 put spreads expire in May at something for some value, right? Ideally, they expire worthless and the stock trades just over $40 on May expiration, or between here and there, and we buy those back at a profit. If the stock continues to decline, again, we took $5.60 in for rolling that trade down, and so we're in a really good situation in terms of profit. So that's how we did trade repair on Cree. Now, let us remind you of two things. One, the high for last year was on today's date, right? So if you go back and look at April 20th last year, that was the high all the way until the July lows, which were the lows for the year. So we're taking some profits. We had some DANG, right? DANG, 10 strike January 2012 calls, totally in the money calls. Those were up 20%. We cut them today. We looked around for our stock portfolio, anything that we were long, where we had just put the position on within the last 3 weeks and we were up 20 to 30%, gone, right? We cut bait, we took the profits, we're raising cash, and then we used some of the cash today to buy even more June 130 strike SPYs. You could add to your VIX call spreads, but what we like about just adding a naked long put is that we could sell a put above or below that to kind of absorb some of the cost of that. So depending on what the S&P does, if it continues to trend upward, we could turn that into a short put spread. If the S&P continues to trend downward, we might actually sell a strike below that where we think it's not going to go, right? Just to take in some additional profits. So I like the fact that being naked long, that SPY, which is just the iShares Standard & Poor 500 tracking ETF, we're long that June of this year SPY 130 strike. And I like that you can either sell a put above or below that in order to adjust the structure as we move through May and kind of into June to see if we get sell in May and go away. Now, if we get sell in May and go away, it's going to be great to be long those puts naked because you're going to get true price. Meaning, if you want to take those off at a gain, you're going to get true price as opposed to having a spread in which there's going to be a lot of noise on the out of the money strike on your spread. Okay, so that's what we're doing today. Now, another thing, the VIX it broke 15 to the downside in the open today, and then it's traded up ever since. So the reality is that you may want to consider being naked long some VIX calls. Normally, we like having out of the money VIX call spreads, but if the VIX is going to continue to get crushed and people are going to just not give heed to any of the big macro events that are going on out there, considering we're in the middle of earnings season, we're coming up on a slow time of the year seasonally, and the VIX is really ridiculously low in terms of the last couple years. All of those things say to me that you probably want to get some naked long call exposure on the VIX just as a hedge. So be prepared to lose 100% of that, but you want to put that on ahead of time, right? You get the insurance on your house before it starts burning, not afterwards. That should wrap up. Oh, now keep in mind that we do have long put butterflies on high flying names that haven't yet reported, like Netflix and F5. F5 is today after the bell. We'll do some trade repair tomorrow depending on what happens with those. But we've got put butterflies on high flyers, and the reality is that it's really nice doing the put butterfly rather than being naked short a put spread, because you'd rather have a bearish bet on and be wrong and just lose the premium, right, that you paid to be long. Plus, you can adjust the trade, right? If you roll those down, a lot of times you're going to recoup either what you paid to put the trade on, meaning you can get out of there for break even, or in the case of Cree today, you can take it, roll down that top strike to the bottom strike and turn it just into a short put spread for a really good premium. So I like going into earnings long a put butterfly as opposed to being naked short a call spread or a put spread. We'd rather sell put spreads on the out months, meaning the months that there's no earnings. So instead of January and April, right, you sell spreads in February and March, because there seems to be not enough to definitively send the stock one way or other in a straight line. And so when you get choppy trading action, you take advantage of a move in the stock that's greater than 3 or 4%. You see a down move in the stock greater than 3 or 4%, and it's in between the months where you're going to get earnings, and there's not a ton of headline risk. Then you can sell those spreads then, and that's our usual trading style. But going into earnings, those months, especially on the high flyers, the names where there's a big short interest, all that kind of thing, we like to be long a put butterfly because it gives us the greatest flexibility for trade repair coming out of the earnings event. All right. Well, thanks so much for tuning in today. Please sell something, right? It's April the 20th. This was last year's highs. The market's ripping higher, and you probably have a profit in something, especially if it's a short-term trade. If you bought something in the last 2 or 3 weeks and you're up real big on, strongly, strongly consider taking that off the table today and raising some cash. Thanks for joining us again on Lunch of the Market. Don't forget to check out America's Favorite Traders, Pete Najarian, Zachary Karabell, Dan Fitzpatrick, all available right now for free on iTunes. Just search America's Favorite Traders on iTunes, or you can go to magnumopusfinancial.com, and right there on the homepage there's a big red button with the face of James L. Tucher, Patty Edwards, and Jared Levy. Click on that. Boom. You're going to get all 13 episodes, which is 10 episodes from last season, and then another 5 from this season. So maybe last season was only 8 episodes, but I think it was 10, which would mean they have 15 episodes of America's Favorite Traders. Either way, there's tons of great stuff there. It's all for free. It's to help you get educated. Thanks for joining us again today. Have a great day, and we will see you tomorrow.